As I said, a lot of earnings coming out today, and so I thought I'd choose two quick ones that are favourites of the call here. First up, Coles maintaining its dividend despite first half net profit being lower on the back of elevated COVID costs, taking a $150 million bite out of the bottom line. Revenues up slightly, sales higher in the first quarter with the restrictions starting to ease. Things are looking up for the second quarter. Scott, what did you think of the Coles result?
Gosh, I didn't think it was a terrible result, quite honestly, given those circumstances you just mentioned. The fact that last year we had really elevated sales and profit, for revenue growth of 1%, I thought it was a really, really good result at a top line level. Bottom line, I think the cost thing you mentioned is a really, really important one. We may or may not talk about it through the rest of the program, but the cost inflation right across corporate Australia is really marked this time. I think if you ask me about the themes from February 2022, I actually think cost inflation would be the one, whether it's Coles and Woolies when it comes to COVID costs, even people like, some of the IT companies who've been having to pay through the nose for techies to come and work for their businesses. It's a really important one. So not a terrible result. The watch out for me for Coles, even though the shares are up today, is you got that, net profit down a little bit, but still on a relatively elevated level of sales. Remember, of course, that while we did cycle on a great year last year, the last 6 months, July to December, was also marked by lockdown. So it wasn't like we've gone from COVID to non-COVID times. I'm not sure what the actual numbers would look like in terms of the number of days locked down. In Victoria, certainly a whole lot less this time around, but it wasn't exactly a free half. So I wouldn't be at all surprised this time next year to be talking about another profit decline on the back of a sales decline this time, because we do go back to cafes and restaurants, simply buy a little bit less from Coles.
Okay, so do you like Coles at these levels?
I don't, mate. I can't pay that price. Both Coles and Woolies are pretty expensive, given the relatively anemic level of growth. The dividend's pretty good. I don't mind it if you're looking for a super cornerstone. I'll say underperformer. No one really looks for underperformers, but if you want a cornerstone position in your portfolio, you can do a lot worse than Coles. But no, I wouldn't be buying it, mate.
Okay, Gary, what do you think of that?
Yeah, similar view to Scott there, really. So not great, not cheap prices here. But I mean, look, I do tend to think that the costs will be probably, like a lot of businesses are definitely having those cost rises there, but I think kind of Woolworths and Coles there, they've probably had the COVID cost, the cleansing, the total, they've been probably over the top on that side. So once we get through COVID, I think those costs will really drop off quite substantially.
Right.
And I still think those businesses will be in more dominant positions. It's going to take a little while for some of these small operators to get back and going again. So I don't sort of see that being, I actually think the costs will probably taper off. So maybe sales will taper off, but so will costs. So I think profitability will still remain pretty robust for those sectors. So
would you be buying Coles at those levels?
I'd prefer Woolies.
Right.
But right now, actually, I think Wesfarmers near $48 is probably more attractive than the other two, as that's come off from 65 back to 48. Big technical level for me around 48. So been watching that pretty closely, watching for it to come down now. So it got really close here today.
Right.
So you got to kind of buy these stocks, the good stocks, when they're on
Okay, so if you're saying if it drops below 48, hold off. If it bounces off 48, then Wesfarmers is a buy.
Yeah, I just noticed Wesfarmers has been coming off quite a bit.
Yeah.
So in terms of sort of areas of support, 48 looked like a big level where I think it might be the first support zone where it might get some support.
Right.
So if a client's looking to top up, like oftentimes they might just trim portfolios, like stocks like Wesfarmers and BHPs, and like right now Woodside's on fire, so you might do some trimming here and then look to buy some back later on when they're not on fire. So definitely Wesfarmers have trimmed some of that, so I'd be looking to probably add some of it back in again here. So
the other stock of the day I thought I'd throw in is another favourite, one of our big health stocks here in Australia, global ones, sort of part of the big four, I suppose. Cochlear maintained full year profit guidance, hiked its interim dividend despite profit sliding 28% as margins came under pressure. Group reported an increase in revenue but said its net profit margin was likely to remain below its target of 18% for the next year or two. Shareholders receive $1.55 a share dividend. That's up 35%. Gary, what do you think of Cochlear?
Yeah, it's a great result. Obviously, ahead of expectations by some margin. So market's going to receive that pretty well. Hence, we've got a bit of a jump here. So I think that's quite good for the share price in the short term. Still got to look at the val. We're still looking at, 45 for, probably looking at about 38 PEs for next year. So with that guidance of being a bit higher, maybe that's around 35, 36 times. So still pretty pricey. Yeah, right. But obviously a great business. Always pay a premium from great business. But I think CSL probably got cheaper at the last low.
Yeah.
Probably a better business on a lower multiple. Cochlear is still on a reasonable multiple, even though that's a bit of an upgrade.
Yeah.
The PE is still pretty high. So short term probably go higher, but I don't think it goes too much higher because I still think the PE is reasonably demanding.
Okay, Scott, Cochlear.
I agree with Gary's view on the short-term PE. I've probably got a more robust long-term expectation on Cochlear Koshi, and it comes down to the sheer long-term tailwinds of this business. Now, also let me put the risks up front. It deals with a mechanical solution, let me call it, or an IT solution to what could be solved with things like gene therapy in future. So that's the big watch out. Other than that, if you think about the growth of the developing world, the growth of wealth, the growth of the number of people, the growth of medical interventions in the developing world, and think about Cochlear's long-term tailwinds, you've got probably 2/3 of the world who can't afford cochlear implants right now. China's got a program underway that it does relatively regularly for that sort of stuff, but even there, the actual diagnosis is really low as a percentage of the population. So if you kind of think about the next 20, 30, 40 years, and I'm literally looking out this far, I think Cochlear is a really good, super long-term, probably one of the best long-term options in Australia. Again, asterisk on that potential gene therapy or something else that might undermine its market, and frankly, be a good solution for those with hearing issues. So I can't complain too much if that is the case. But as long as you keep a watch out for that one, the sheer growth of the company's potential market over those few decades, I think it's going to be. It won't be astronomically. You're not talking about 25% a year type stuff, but really, really, really good long-term compound growth on the back of people who can afford it, people who are getting the medical intervention around much of the developing world. Right. So I really like Cochlear for the ultra long term. It's a great cornerstone position. It's not cheap right now. Gary's exactly right. I reckon though, if you've got a 10+ year time horizon, Cochlear is a good investment.